Hey everyone, Fisker Automotive reported third quarter earnings results, and as I do with most of the companies that I follow, I update my buy recommendation every quarter when the earnings come out. And so that's what I'm going to do with this video here and Fisker Automotive. I'm going to update my buy recommendation. Coming into the quarter, I had Fisker stock rated as a hold. I did not have it rated as a buy. So you're going to want to tune in to see if I'm upgrading, downgrading, or keeping that recommendation the same. But before I provide the recommendation, I'm going to highlight the big picture items that came out of the company's quarterly results.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's jump right into it, starting with Fisker announcing that it's now delivering in 10 countries and it's expected to add 2 more markets later this month as operational momentum accelerates in the fourth quarter of 2023. Remember, the third quarter, the one that just finished, is the first quarter where Fisker really ramped up the deliveries and production and became a full-fledged car manufacturer seller. Well, I shouldn't say manufacturer, but car seller. It outsources its manufacturing, which I will talk a little bit more about later in the video. In the third quarter was Fisker's first quarter with meaningful automotive sales revenue. Total revenue in the quarter was 71.8 million, but the gross profit margin was negative 17% on a generally accepted accounting principles basis, GAAP basis. And so with all those losses on the bottom line, Fisker needed to raise more money in the quarter. It raised 450 million in gross proceeds during the quarter, bolstering its quarter end cash balance to 625 million. The company has an additional $550 million in proceeds available as part of its recent convertible notes transaction. So the company has more hundreds of millions of dollars available in case it needs to tap markets again to raise capital. So during the third quarter, 4,725 vehicles were produced and 1,097 vehicles were delivered. Deliveries have since accelerated as Fisker begins optimizing its last mile logistics and expanding its delivery infrastructure to achieve full-scale effects in fourth quarter and beyond. Already in the fourth quarter, the company has delivered 1,200 vehicles in October, which exceeded the entire third quarter delivery volume. Let me go through this. Let me go back and go through this. So its third quarter, that's when the company delivered 1,097 vehicles. The third quarter ended before October. In October, the company delivered 1,200 vehicles in October. And so that exceeded the entire third quarter delivery volume. So already the fourth quarter is shaping to be a much better quarter for Fisker compared to the third quarter. Although it's still not shaping to be as strong as Fisker was forecasting. Remember, just a few short months ago on September 26th, so not even 2 months ago, Fisker anticipated that it was going to deliver 300 vehicles per day in the US and Europe by the end of this year. And so it's not there yet. It's nowhere near that pace, and we're only a month and a half away from the end of the year. It's November 13th as of this recording. And according to October delivery numbers of 1,200, that's 40 vehicle deliveries per day, just 40. And the company was talking about 300 in a day. So it needs to 7 or 8x from here in order to hit that target it was discussing just a few short weeks ago. Needless to say, Fisker is behind on that forecast, and that's partly one reason why investors were punishing Fisker stock when these earnings results came out. The stock is down 5% as of this recording, 5.2% as of this recording in after hours after these earnings results came out. So, like many other EV sellers, Fisker adjusted its pricing lower on all trim levels and opened calendar year sales 2024 orders. So it's now accepting orders for 2024. The current pricing for its Ocean Extreme is $61,500 on the high end and then $38,999 on the lower end. I would not be surprised if more price cuts were not to follow. Price cutting has been a common theme for electric vehicle companies in 2023. There's been several rounds of price cuts. Tesla has cut its prices several times, followed by competitors who also cut prices. And EV sellers are finding that customer demand for EVs is not as strong as they thought. In 2021 and 2020, they were experiencing all this interest from customers, and EV makers got excited thinking, oh my goodness, look at all this consumer demand for electric vehicles. This is going to be the next hottest thing. Let's get in. Let's spend billions of dollars and make a new EV company because demand is so strong. Little did they know the only reason, or the main reason, why demand for electric vehicles was strong in 2020 and 2021 was because legacy automakers were severely supply constrained. They weren't making nearly the amount of cars they usually make. And so consumers wanted to buy cars, but they didn't have those legacy automaker cars available to buy. And so they looked to EV car makers because they just needed a car. They just was looking for what's available, and EVs were something that were available at the time. But now that the legacy automaker supply has increased, the demand for EVs has diminished. Demand for EVs has diminished. And you can say, yes, it's partly due to higher interest rates and macroeconomic uncertainty. And you would be right, that's true. But my opinion is the primary cause is that legacy automakers have increased supply. And when consumers go out to look for a vehicle to purchase, very often a legacy vehicle internal combustion engine is the better one to buy for a consumer because it just offers better economics, better price of ownership, and more convenient. So for those reasons, it's been a difficult going for EV makers. Although I like Fisker's plan of attack here. They're outsourcing manufacturing, and so they haven't had to spend as much money as other EV companies to get themselves going. And I like this interesting concept with the recharging solar roof. I think if they can really ramp up that technology and make it so that these cars are self-recharging at least to the tune of, a couple of 100 miles per month, if you can get that from just self-recharging from the roof, recharging from sunlight, that could be a game changer. Right now it's in its really early stages. You can hardly get any miles out of that recharge, but it's interesting, and that's something that if they are able to achieve, that can certainly increase consumer demand because it would add a significant amount of convenience for folks who now no longer have to worry about charging and all the time it takes to charge and the money it takes to charge if they can just recharge the vehicles with the solar roof. I mentioned earlier the company is losing a lot of money on the bottom line, and look at the quarter that ended on September 30th. They generated 71.8 million in revenue. The cost of goods sold alone was already above revenue at 83.9 million, and on top of that they had more expenses, 78 million in selling, general and admin expenses, and so that led to a net loss on the bottom line of 90 million for the quarter. And to help fund some of those losses, the company sold more shares of stock and issued more convertible notes. You could see here shares outstanding of 343 million was up from 300 million shares outstanding in the same quarter the prior year. Of course, the more shares outstanding, the worse for existing shareholders, because now you're going to get a smaller earnings per share because there's more shares outstanding. And so if or when the company does achieve profitability, it has to share those profits among a greater number of shares. So looking at the balance sheet, the company has 527 million of cash and 97 million of restricted cash. It also has 549 million of inventory, as it produced significantly more vehicles than it delivered in the quarter. Management said that its deliveries are on its way, its en route to customers. Hopefully, it can get this inventory off its balance sheet and into customers' hands because the company needs cash. It does not need to be holding on to inventory. Hopefully, it does not need to offer big discounts to get rid of its cars, to get rid of its inventory, because that could have significantly negative consequences for Fisker Automotive. I mentioned earlier the company looked to debt holders or lenders to raise more capital, and you could see here it's got $1.1 billion of convertible notes outstanding. These are due the year 2025 and 2026. The way these work for the most part is if Fisker's stock price exceeds a certain level, these lenders will convert the debt into shares of stock, which will dilute shareholders. There will be more shares outstanding. If the shares are not above a certain price, the lenders would prefer to tell Fisker to pay them back in cash instead of giving them the stock. So the lender has the option of taking the more favorable choice, either stock or the cash. And so Fisker is in the unfavorable position here in offering the lenders a convertible note, but it's something that it has to do in order to raise capital because it's losing so much money on the bottom line, and the company's so risky because it's yet to prove itself. It has limited options on how to raise money, and so it has to take what it can get. Finally, I wanted to look at the cash flow from operations in the quarter that just ended. The company used up or lost $308 million in net cash from operating activities. That was up significantly from last year's $85.9 million in cash from operations, mostly due to the fact that it spent a lot of money. I showed you already the hundreds of millions of dollars in inventory that it has. That's a change in operating assets, and that's why the company's cash flow from operations was significantly negative. If it can start delivering those vehicles and turning them into cash and making sales of its vehicles, it can reverse these losses in net cash from operations. The company's business model of outsourcing its inventory production could help the company generate cash flow sooner than perhaps some other automakers who are having to spend billions of dollars in ramping up production, in ramping up capacity, and therefore making it difficult to generate cash flow. I'm looking forward to see Fisker make progress in this front. But to answer the question about my recommendation of Fisker stock, I had it rated as a hold coming into the quarter. I'm disappointed in Fisker's quarter. I did not like what I saw from the quarter. Namely, I didn't like the slower ramp up in deliveries. I didn't like that it had to cut prices and still not generate significant increase in deliveries or consumer demand. For that reason, I'm slightly downgrading Fisker. I had it as a hold going into the quarter. I'm bringing it down closer to a borderline of a hold slash sell before I can recommend this stock as a buy. I need to see more progress in ramping up production, ramping up deliveries, and turning the gross profit margin positive. It shouldn't be that hard for Fisker to turn that gross profit margin positive since it's outsourcing the production. I should change how I said that. I don't mean it shouldn't be that hard. I mean it should be easier for Fisker to generate gross profit margin positive than it would be for an automaker like Rivian, because Rivian is not outsourcing production. So it's easier compared to a company that's not outsourcing production. So I'd like to see Fisker talk about and achieve gross profit margin positive in the next 2 or 3 quarters at the very latest. But before I let you go, if you gained any value from this video, please subscribe to the channel. It'll really help me make more videos just like this one. Thank you so much for watching.